Hi, welcome once again to this series of discussion on the forex market. I trust you're keeping safe during this coronavirus pandemic. It's not been easy. The numbers here in Nigeria has been increasing, and we all have to do our parts by staying safe, avoid large gatherings, and remember to always wash your hands. Drink water so you stay healthy. Exercise indoors. So quickly, we would go on to today's this particular discussion on understanding various candlestick patterns. Now, for you to have been here, I'm sure you would have seen my previous video in which I explained the formation, how candlesticks form and what they represent. If you haven't seen that, please remember to go back to the video on candlesticks and understand candlesticks. Because if you don't, you probably won't get what we're saying in this particular video. So quick, let's go on to today's discussion. So basically, in the last discussion on the candlestick, I explained how candlesticks are formed, and then I made an example of one of the candlestick pattern, which is called a doji, an indecisive candlestick. And someone asked a very beautiful comment. Someone asked a very beautiful question in the comment section, and please do keep the comments going on. Someone asked that is the candlestick, is it an holy grail? Does it mean the doji candlestick formation, is it an holy grail? Does it mean every time you see a doji, the market is about to go the other way around? The answer is no. It is not an holy grail. It's not. Basically, the candles, these formations, all the formations I'm going to talk about, including the doji, it's a confirmation. It's a confirmation for you to enter a trade. So, for example, you see, we'll get to the point where we'll talk about resistance and support. Resistance and support. I'll go do another video for that, basically. So at a resistance, if you see a doji, that's an indication of an opportunity to sell. Or a support, you see price on a support, is an opportunity to buy. I'm going to explain resistance and support very, very detailed in another series, not today. But basically what I'm trying to tell you is, or it depends, if you're using an indicator and the indicator is showing you that price has been overbought, that means price has been exhausted, it's time for price to reverse, and then you see a doji or you see any of this candlestick pattern, that is an indication that yes, price is about to change, price is about to reverse, about to turn around. You're selling and then you see one of these candlesticks pattern that indicates a buy, that indicates an uptrend, that indicates an end to the downtrend, to the bearish movement. Basically, that's how you use candlesticks formation. They are very good for confirmations of when to enter a trade. So join me as we unveil some of these basic candlestick patterns. There's a lot of them, but I'm going to give you the most common, the ones that you can easily identify. So let's go on. So the first we'll be going into the bullish reversal pattern. What does it mean? It means how these are candles formation, candle patterns that show that you see them in a bearish market, in a market that is going down. When you see them, it means it's about this bearish run is about to end. You're about to have a bullish run. So you see them in a downtrend, you see them in a bearish market. So when you see these patterns, it means the market is about to go up. That's what it means. So I'll start with the first one. It's called a hammer formation. Now this is one candlestick that shows a bullish reversal. How is it formed? Remember in the last discussion on candlestick, for a bullish candle, the candle opened up here and then it went down. Sellers tried to push the price downward. They tried to push it downward. It also came up here. Remember, it came downward. It formed this low of this candle. Also came all the way up here, but eventually ended up closing at this point. So market opened, sellers drove the market down, but unfortunately they were not able to close it down here. So the buyers came up all the way and pushed the price up, and the candle closed here. So this, you can see, it looks like a Thor, like Thor's hammer. You know Thor from Marvel. It looks like a hammer. That's why it is called a hammer. So it's an indication that the market is about to reverse to a bullish market. So basically, this shows a rejection of lower prices. The sellers tried to push price here, but it was rejected. Price ended up closing up here. So this is what the candle looks like. You can run through your charts maybe by the end of this series. Look through your charts, look at the various candlestick formation that I will discuss in these videos, and see how they played out. So basically, how do you identify this hammer? It has a very little, or at times doesn't even have any upper wick, any upper shadow, very little or none. And then the price always close at the top, almost a quarter of the range of the whole of that particular candle. You can see this is the body of the candle. It's almost a quarter of this, of the whole of the candle. So that is how to identify a hammer. Also, this lower shadow, the lower wick, is always about 2 to 3 times the length of the whole body. You can see the body is about a quarter, while the lower wick is usually about half or 3/4 of the whole of the candle. So basically, this is a hammer. This is what Thor's hammer look like in the forex market, and it shows that the buyers beat the sellers. The sellers tried to push the price down, but no, the bull came and all the way pushed the price all the way up, and the price eventually closed here. So that is a hammer. So I was able to take a screenshot to show what it looks like in the market. So this, you can see, this is a chart. I took a screenshot. Now this was happening. This candle, bearish. There was a dodgy here. This was a bearish. What does that indicate? So this is a bearish. This was a bearish market, and then lo and behold, and a hammer came through. You can see this is a hammer, and then what happened next? You can see the hammer, the small body, the long lower wick, long lower shadow. Then what happened next? The market reversed. It reversed, so it shows a bullish reversal. Shows a bullish reversal. So that is a hammer. Remember, we're still on the bullish reversal pattern. So let's go on to the next pattern, which is a bullish engulfing pattern. A bullish engulfing pattern. Basically, when you see these two candles like this, remember the first one is a bearish candle. Price opened here, went up, came all the way down here, formed the low. This is the high, and then eventually bearish. It went down, closed here, and then the next candle that comes up. Remember where the previous candle closes, the next candle opens. So this candle opens up here and went all the way. It came down, formed the low, went all the way up, formed the high, and closed up here, up, closed way above the previous bearish candle. So it engulfed it. So the bullish candle engulfed the bearish candle. So that is a bullish engulfing candle. Remember, it's that simple. What this means, what this pattern tells you is that the buyers have totally overwhelmed the sellers, and they are now in control. And it shows that there is a potential change in the bearish market. There is now going to be a bull's run. The bulls are coming in. The bulls have taken over. The bulls have overwhelmed the sellers. You can see it engulfed the bearish candle completely. So that is the bullish engulfing pattern. Now let's look at one of the charts and see what played out. Okay, great. Now you can see this was a chart I got from a website. You can see what happened here. This happened. You can see there was this candle turned out to be bearish. and then a bullish candle came and covered it. It engulfed the whole of the bearish candle. And then what happened next? Boom, boom, boom. And see that goes all the way up. Even here, you can even see this as well. You can see this candle, and this engulf the whole of it. Engulf the whole of it. So that's basically, it's a bullish engulfing pattern here. This is a typical example, because this one, the candle didn't engulf the lower wick. So this is a typical example. This happened, and then price goes all the way up, all the way up. So that's a bullish engulfing pattern. So up to the next one, the tweezer bottom. Tweezer bottom. Remember you see this at the end of a bearish run. Remember, so when you see this pattern on a bearish run, it means the bearish run is about to end and a bullish run is about to commence. So a tweezer bottom, this tells you that the market has difficulty trading lower after 2 attempts, and it's most likely to head up higher. What happens in this particular formation? This is a bearish candle. So price opened up here. Price opened here, and then it pushed down all the way down. Sellers pushed the market here, formed this low. But then was the market able to close here? No, it didn't close. This candle didn't close here. The buyers pushed up the candle up here, and it ended up closing here. Now, after this candle closed, the next candle opened. Remember, where the previous candle closes, the next one opens there. So this candle opens up here. And then what happens after this candle opened? The sellers still pushed. They pushed the same price down here. Pushed it here, the same place. Pushed the price here. Were they able to close it here? No. The bulls still came and said, no, price ain't closing down here. The bulls came, and remember the bulls movement all the way up. That's how the bulls strike. So they struck this and pushed the price all the way up and closed the price here. So the tweezer bottom, when you see this at the bottom of a chart, it means it's an indication for a reversal, because price has rejected this area twice. Price have refused to close lower twice. So it's a clear indication that price is about to go up when you see that. So run through your charts. I wasn't able to get an illustration, but it's there. Just because of time factor, I couldn't run through my chart. Look at your chart yourself, and you see the tweezer bottom and see what happened afterwards. So on to the next one, we have the Morningstar. Yes, very romantic pattern. This is called the Morningstar. Remember, you see it at the end of a bearish run. Basically, a Morningstar tells you that the sellers are exhausted and buyers are actually coming into control. What happens? You can see it. You can see this is how it forms. 3 candles as opposing to the other ones that are 2. So first off, this candle opens. It opens here, and then pushed down from the low, and then closed here. Closed a bearish candle. Now the next candle comes up, down. It opens here. Remember where the previous candle closes, the next candle opens. It opens up, down, comes back and closes at the same point where it opens. So basically, this is a doji. This is a doji, D-O-J-I. This is a doji. So bearish, doji, and then when this candle closes, another one opens, comes down, forms the low, goes all the way up, forms the high, and closes here. The same pattern, the same height with the bearish candle. So once this happens, bearish, doji, bullish, it's a clear indication that market is about to reverse. The bearish run is about to change to a bullish run. So that's it. That's it for the Morningstar. If you have any questions, don't ask me. I'm going to respond to you. So we're done with the bullish reversal patterns. Bullish, that means the market is about to reverse to a bullish market. You see these patterns in a bearish market. So quickly, let's go on to the bearish reversal pattern. What do you see in a market that is going up? In a bullish market that tells you, hey, market is about to fall down. Market is about to change direction. So you see this candle patterns in a bullish market, in a market that is going up. You see them up, which means price is about to go down. So the same way we have the hammer in a bullish reversal, we have what we call a shooting star in a bearish reversal. It's like the hammer held the other way around. Tall hammer smash. So the shooting star is basically a bearish reversal candlestick pattern. It shows that they've rejected, that the market has rejected the higher prices. What happens? Market opens up here, and then it gets pushed all the way up. The push. Can we maintain the momentum of the bull's run? No. And then its price is pushed all the way down, comes down here, forms the low, and ends up closing here. So once this pattern is seen, it means that there's an exhaustion. It means the bulls came in, the bears came in and pushed the market down. Remember, the bulls tried to push the market up, see if they can close it up, but no, the bears came and pushed the market down, and it closed as a bearish market with a very, very long upper wick, a very long upper shadow, and a small body, which is about a quarter of the whole of the candlestick. So basically, when you see this is an indication that the market is about to change from bullish to bearish. So let's go on and see an example of a chart. What happened in this chart? You can see this bullish candle, bullish candle, bullish candle, candle closes. This bullish candle closes. The next bearish candle opens. All they push price up, but no, price came all the way and formed the high, and it was pushed down by the bears. It comes all the way here, forms the low, and then it went up a bit and closes bearish. So you can see it's a very long wick at the top side, clear indication of a shooting star. And what happens? Boom, you make your wish. Remember when you say shooting star, you make your wish. When you see the shooting star, make a wish that you want market to sell and sure going to obey. Especially when you see it at the end of a bullish run. So what happens next after this shooting star appears? Boom, 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 chow, chow, chow. Boom, boom, chow. Market comes all the way down. Market changes direction to a bearish market. So shooting star, that easy. Remember, always trade them with confirmations. It's that simple. Always trade them with confirmations. So up next, we have the same way we have a bullish engulfing, we also have a bearish engulfing. Same pattern basically, but this time around is the other way around. So the bearish engulfing pattern basically tells you that the sellers have come in and they have kicked out all the buyers. They've kicked out the bulls, and the bear is taking over. What happens? You see a candle, see two candles. This candle opens up. Remember, bullish candle. It opens up down here, and then comes down, forms a low, goes all the way up, forms the high, and ends up closing here. And then the next candle opens up, comes up here, forms the high, goes all the way down, and overwhelms the bullish candle. It closes, it comes down, forms the low, and closes at this point, closing below the open of the previous candle, and even below the lower wick. So that's, my friends, is a classic example of a bearish engulfing market. So we're going to look at a live chart and see what played out there. So here we are. So we see this here. We have this bullish candle, and then the bearish candle comes and overwhelms the buyers, and boom, it changes direction of the market, and from a bullish run, it now becomes a bearish run. So even from this one candle, after this candle, you can now enter a sell at this point, and you'd have made money with this little run. So remember, I talked about confirmations, using them as confirmations. So this is an example. We've not talked about resistance and support, but this is a very good example of resistance and support. Basically, resistance is a point where market gets to and finds it difficult to break out from it. And support is also the same thing. I'm going to go into details of that, but I just wanted to use this example to also buttress that point. You can see on this particular line, this is a resistance. You can see price try to break out, but no, they didn't break out. So that formed a resistance. I'm going to go into details of resistance very soon. So at every resistance, you see these candle patterns is a boom boom chow. So that's it. So quickly, let's run on to the next one, the tweezer top. The way we have the tweezer bottom, which you see at the bottom of a bearish market, you also have a tweezer top, which you see at the top of a bullish market, which indicates that market is about to reverse. So basically, the tweezer top tells you that the market is finally very difficult to break through the high price twice. It has tried twice and it's trying to break to, and it failed to break through, and then it ended up closing below. This candle opens up at this point, and then in a bull's run, you see at the top of the chart, the bull's run, the market opens up, goes all the way up here, tries to close here, but no, it was pushed. The sellers, the bears pushed the price here, and price ended up closing here. And then price, remember, when it closes, another candle opens. So the price opens here on this candle, and it goes up, forms the high, but it still wasn't able to close anywhere above it. It was pushed down by sellers, by the bears, and it ended up closing here. So this pattern is a tweezer top. Once you see this, is an indication that the market is about to reverse from a bullish cycle to a bearish cycle. So up next, we have the evening star. The same way we have the morning star, we also have the evening star. Remember, the morning star was for a bullish reversal, while for the evening star is a sign of a bearish reversal. You see it at the top of a bullish cycle, at the top of a bull's run. When the market has gone up, you see it there. It indicates that market is about to go down, it's about to change direction. So an evening star basically tells you that the buyers are exhausted and the sellers are now coming into the market. So the bullish candle opens. You see, this is the pattern. This is what it looks like. It's this bullish candle opens, comes down, forms a low, goes up, forms a high, and then ends up closing in here. So immediately this candle closes, the next candle opens up, down, closes at the same point where it opens, forming a doji, and then it comes all the way, opens the next candle, up, forms the high, all the way down, forms the low, and closes here. The same formation. So once you see this, it means that the sellers have now overwhelmed the buyers, because after this point of indecision, the doji candle shows indecision. I mean, there's an exhaustion in the market. So this happens, and then the next candle follows as a bearish candle, close. Bring out your gun and you shoot, because it's about to go down. So thank you very much. At this point, I've been able to give you some basic candlestick pattern for the reversal, bullish or bearish. So thank you for sticking around. The next, we're going to talk about some indecision candle patterns, the doji and the rest of them. So make sure you stay tuned. Make sure you subscribe. Hit that subscribe icon on your screen. Hit it. Hit the like icon. If you have any question, make a comment. I'm going to reply you. If you want to reach out to me personally, I'm going to drop my number in this chat, in this video, or maybe not. Just make a comment. I'm going to reply you. Thank you very much. I'm Emmanuel Otabo, as always, here to answer your questions and here to give you quality video education of the forex market. Take care, stay safe, and remain blessed.